Look at your RRSP balance in your investment account. Now take 30% of that number away. That is what your real RRSP balance actually is. Now, without proper context, the fact that 30% of your RRSPs are not actually yours might make you never contribute to an RRSP again. But to keep you from getting sucked into the world of poorly informed RRSP concepts, I am giving you the entire RRSP playbook to help you fully understand them. When you contribute to an RRSP, you get a tax deduction. The deduction is based on something called your marginal tax rate. In Canada, the more you make, the higher your tax rate. Now, this confuses some people because they assume that if they get a raise at work, they'll bring home less money if they move up into the next tax bracket. That is incorrect because we have something called a progressive tax system, meaning that your increased tax rate only applies to the next dollar earned, not total dollars earned. So for example, if you live in Ontario and in 2025 you make $253,414, you will pay a combined average tax rate of all the lower income tax brackets. That will equal about 36%. But on the next dollar you earned in 2025, that dollar will be taxed at 53%. So your entire income will not be taxed at 53%. It's just your next dollar. This is called a progressive tax system. So now that we understand our tax system, we should be able to move forward with understanding the value of a tax deduction. The way I like to look at an RRSP contribution is that it allows me to defer the highest tax part of my salary to a later point in time. For example, if I make $270,000 per year, I will have about $16,600 of income that is getting taxed at 53%. So that's not great. If I have the option to choose not to earn that extra $16.6 thousand in the current calendar year, but defer it to a later year where I won't have any other employment income, that's better. When I make an RRSP contribution, I get a tax deduction equal to the amounts I contributed. A deduction simply means that it deducts or subtracts against my earned income. So I got taxed as if I earned $270,000 throughout the year, but because I contributed $16.6 thousand of income to an RRSP, the government now needs to recalculate and refund me the tax on the $16.6 thousand contribution. Now, in the above example, I have just deferred 53% in taxes on that $16,000 income because I now have $0 earned in the higher income tax bracket. By the way, this works in every tax bracket, not just the highest ones. I just like to use this as an example. This all boils down to a simple principle. If I can get a tax deduction at a high tax rate when contributing and get taxed at a lower tax rate when withdrawing, then that is a good financial decision. I will address objections to this later in this video. Now, apart from this, here's a niche strategy around deductions that most people are not aware of. Let's say you're working in tech. You don't have to be working in tech. This is just an example because of a lot of my clients work in tech. Let's say your company is just about to go public. You're making $155,000 per year, which puts you in a 43% marginal tax bracket. However, your company is going to IPO next year and you have stock options that when triggered would put your income in total up to $300,000. That moves you firmly into the highest marginal tax bracket. So you're debating whether or not to max out your RSPs this year or wait until next year when you trigger your stock options and move into the higher marginal tax rate. In a scenario like this, you can still contribute this year, but carry forward your RRSP deduction to the next year and then contribute for the next year and claim both this year's and next year's contributions against next year's income or the higher earning year's income. That means that instead of getting a tax deduction valued at only 43% today, you're getting a tax deduction valued at 53%. That is a 10% net tax savings just by waiting a year to claim your deduction. And in the meantime, your contributions have had the opportunity to grow without tax while remaining invested in the RRSP. Now, this can be done in any scenario where you expect your income to be higher in the next calendar year. You can contribute, but you don't need to claim the deduction. Next, let's look at a common objection to RRSPs. What if I need the money before I retire? There is a common misconception that withdrawing money from an RRSP before age 65 or before retirement has penalties associated with it. That is simply incorrect. If I were to withdraw money from my RRSP, the income gets included in my current year's income. So if I have other employment income or rental income or just any other income, then the RRSP withdrawal gets tacked on top of my existing income. It is 100% taxable because remember, it is simply the act of deferring salary. So when I withdraw money from my RRSP, I am now getting taxed on that deferred salary. People often equate withholding taxes to withdrawal penalties. That is incorrect. Financial institutions simply are required to remit income taxes on your behalf. That is called withholding taxes. It's very similar to how your employer remits them when you're getting paid. We don't look at our paychecks and call the taxes our employer remits to the CRA a penalty. We also know that the employer only knows about the income they pay us, meaning if you have other sources of income, you may still owe the taxes to the CRA at the end of the year. It's the same thing with withholding taxes. If you withdraw $20,000 or more, the financial institution is required to remit 30% to the government. It's not a penalty, it's simply a prepayment of income taxes. If you have no other source of income, then the 30% was too high. The government will refund you the amount of money that they owe back to you. Now, withdrawing from an RSP does mean you lose the room. You cannot regain the room in future years like you can with TFSAs. So that is an important distinction. But there are two ways you can withdraw RSPs before retirement and pay $0 of taxes and not lose your RSP contribution room. And that's where we're going next. Let's talk about the two ways you can withdraw money from your RSP without paying any immediate tax. The RRSP Home Buyers Plan allows you to withdraw up to $60,000 from your RSP without paying taxes, so long as you are a qualified first-time home buyer. In order to know if you're qualified, I have linked the questionnaire that the CRA uses in the description. The way this works is that once you enter into agreement to buy a qualified home, you can withdraw the funds as long as they have been in the RRSP for 90 days. There are no restrictions on how to use the money. The rules are that when you withdraw, you don't pay taxes on the withdrawal so long as you repay 1/15 of the withdrawal every year starting the year after you buy the home. If you do not repay or you miss a year, 1/15 of the withdrawal amount will become taxable to you. There's no tax deduction for repayments into the home buyer's plan, and you have to repay the home buyer's plan over a period of 15 years. Now, here's a quick tip that many people don't know. You can designate group RRSP contributions as repayments of your home buyer's plan. If you don't need to use the RRSP to buy a home, you probably shouldn't, because the value of your money compounding tax deferred is very high, and you don't want to lose out on that. Now, let's look at the other way you can get funds out of your RRSP tax-free. The Lifelong Learning Plan, in a similar fashion to the RRSP Home Buyers Plan, allows you to take money out of your RRSP tax-free, but it has different repayment schedules and lower amounts you can withdraw. The plan allows you to borrow a maximum of $10,000 per year and a cumulative maximum of $20,000 from your RRSPs. Now, with the Lifelong Learning Plan, you only have 10 years to pay back the withdrawals. And in the same way as the Home Buyers Plan, you will get taxed on 1/10 of the withdrawal every year you do not repay the withdrawal. In order to qualify, you must be a full-time student at a university. Now, a cool thing about this plan is that you can actually assign it to your spouse as well. So I don't have to be the student. My wife can also access this plan. You cannot use this for your kids though, or any other family members. Once again, if you don't need to use this, I recommend you don't, because taking money out of the RSP will cause you to lose out on all of those years of compounding growth. If you like this and have learned something so far, share this with someone like, I don't know, maybe your spouse, because next we're going to dive into spousal RRSPs. Spousal RSPs were very popular prior to the ability for seniors to split pension income. And most people think that now spousal RSPs are pretty useless. But I'm going to show you some unique reasons why spousal RSPs can still have a huge impact on your financial situation. A spousal RSP allows one spouse, typically the high earner, to contribute to the other spouse's RSP, typically the lower earner. You can't just contribute to your spouse's existing RSP though. Your spouse has to open a unique type of RSP specifically designated as a spousal RSP. The benefit of this spousal RSP is that the higher income spouse can get a tax deduction at their income level, but the RSP is owned by the lower income spouse. You might know where I'm going with this, but if not, let me walk you through the mechanics so you can understand it. Higher income spouse uses their money and their contribution room to make a contribution to a spousal RSP. The money takes 3 years to vest, meaning that if it's withdrawn in the first 3 years, the higher income spouse owes the income tax on the withdrawal. But after that, the lower income spouse can withdraw and all the tax is now owed to the lower income spouse. The idea is that by the time you are ready to retire, you avoid the situation where one spouse has a $2 million RRSP requiring high minimum withdrawals and high taxes, while the other spouse has $0 in their RRSP. In that case, it would be better for tax purposes if each spouse had a $1 million RRSP, and you can accomplish that with a spousal RRSP. Now let's look at some cool spousal RRSP strategies. If I were to make, $500,000 a year, and my wife stays home and takes care of the kids, we will have a very lopsided income tax return. I'll pay hundreds of thousands in tax and she will pay $0. So I've got an option. I can either contribute $30,000 of my income to my own RRSP and get the deduction at 53%, and then at some point I'll withdraw my RRSP and claim it as income under my name, or I could contribute $30,000 to a spousal RRSP under my wife's name, claim the 53% deduction on my taxes today, but now she owns the RRSP. When she withdraws, she's in a lower tax bracket and she can withdraw pre-retirement as long as the money has been in the spousal RRSP for a minimum of 3 years. So she doesn't even need to be retired. And it's kind of a cool trick to split income, but unless you don't need money and don't have emergency funds or TFSAs, it's not extremely useful except in niche circumstances. The real benefit is if I want to retire early before 65 and want to start withdrawing RRSPs early, then instead of having the entire RRSP balance under my name and being taxable to me, if I had contributed half of my RRSP contributions to a spousal RRSP, then both my wife and I could split the income prior to age 65 and pay less tax, which is a huge benefit. Another great reason to consider spousal RRSPs, and this is for the boomers that are watching this, if you are turning 71 and have to turn your RRSPs to RIFs soon, then you can no longer contribute to your own RRSP. However, you can contribute to a spousal RRSP as long as your spouse is under age 71. So if you're making too much money, perhaps you're still working or just not wanting to pay tax on all your pension income at this time, you can contribute some of it, provided you have the room, to a spousal RRSP under your spouse's name. Next, we are going to look at how RRSP contributions can actually have a bigger impact than just helping you pay lower taxes. Our progressive tax system is set up so that it not only taxes us higher the more we make, it also claws back benefits the more we make, which is, in effect, a higher tax rate. So when you factor in not only higher taxes, but also the loss of benefits, you're actually paying a higher effective tax rate than your tax return will show you. There are programs like the Canada Child Benefit and the new Canada Dental Care Program, additional income tested grants and bonds for RESPs and RDSPs, all things that we lose out on if we make too much money. RRSP contributions can help you qualify for those benefits. If your family is on the fringe of qualifying for something like the Canada Child Benefit or the Canada Dental Care Plan, the effective value of your RRSP contribution is your tax deduction plus the added benefits of the extra money you get back from the government now that your income is low enough to qualify. So, for example, let's say you made $100,000 as a family in 2025. You have some dental bills due in 2026. Let's say you're estimating a $1,200 dental bill. You have $10,000 available that you can contribute to an RRSP. For simplicity's sake, I'm going to assume $70,000 was earned by Jim and $30,000 was earned by Pam. In Ontario, if Jim makes the RRSP contribution, he would get a tax savings of $2,965 if he contributed $10,000 to his RRSP based on his marginal tax rate of 29.65%. Now that would lower their total household income down to $90,000. That means they now qualify for the Canada Dental Care Plan and will have coverage of 40% of their dental bill. So assuming a $1,200 dental bill, that is a subsidy of $480. So now the total government benefit of that RRSP contribution is $480 plus $2,965 with an effective impact of $3,445 or 34.45%, even though their income was fairly low, lower than you might think would be optimal to contribute to an RRSP. So to put that into perspective, that $10,000 RRSP contribution for someone making $70,000 had the same net tax impact as an RRSP contribution would have for someone making $115,000 in Ontario in the same year. This applies in so many scenarios: RESP grant and bond calculations, RDSP additional grant and bonds, and so many more. All this to say, the value of an RRSP contribution has the potential to go far beyond just the net tax impact of the deduction. Next, we're going to be looking at how you might be throwing away free money when it comes to RRSPs. Group RRSPs are so often not utilized properly, and failing to do so means throwing away free money. Many employers will offer group RSP contribution matching programs. Knowing the contribution matching program will enable you to make the most optimal decision around contributing. We have clients come to us and say that they're contributing the minimum required amount to get an employer match and then just contributing the rest of their RSPs to a personal RSP plan. Then when we look at their benefits package, we realize that by contributing more, the employer will match more. And this is a simple fix. If you know that the max your employer will match is 6%, but you're only contributing 4% of your salary, bump it up to 6%. Even if that match goes down to 50% over a certain amount, it doesn't matter. It's free money that is not available to you if you don't take advantage of it. So don't throw away free money. Also, you need to be careful to calculate this into your total contribution room. Many people slip up and over-contribute when it comes to group RSPs. They forget that they're contributing to both and then accidentally over-contribute to their personal RSPs, resulting in a lot of issues. Always track this and stay locked in for this next part if you are a business owner, because we are going to be looking at why RSPs for you are a fantastic tool as well. Now, if you're not a business owner, you can skip forward to the next section. Most people, many accountants included, don't recognize the value of an RSP for business owners. And the reason is this delves into a deeper conversation around optimal compensation strategies for business owners, because practically the only way to generate RSP contribution room is to pay salary. Dividend compensation does not generate RSP contribution room. However, on its own, RSPs are superior accounts to hold long-term investments in over a holding company or corporate investment account. One of the biggest reasons is something called tax drag. RSP returns are not taxed in the year they are earned. In a holding company, investment returns are taxed in the year they're earned unless it's an unrealized capital gain, but then there are deferred taxes owed. Dividends, interest income, and realized capital gains all subtract from the real return of your investments, and that means when you directly compare holdco versus RSP, tax drag will have the RSP coming out ahead, apples to apples. Another benefit of the RSP versus your holding company is the ability to shelter investment income from affecting your small business deduction. Over time, if your portfolio starts rolling out a lot of passive income, that can affect your small business deduction. So if you have more than $50,000 of passive income, you'll start to lose your small business deduction. The small business deduction allows businesses earning less than $500,000 to get taxed at a lower rate. Once you hit over $50,000 in passive income, you start to lose that lower rate deduction. Moving money to your RSPs every year means that you will shelter a lot more of your investment assets from affecting your small business deduction. Next, we are going to look at pensions and RSPs and what having a pension means to your decision to contribute to RSPs. Having a pension does not automatically mean that you should avoid RSPs. It just means there's an additional consideration. A pension contribution does not directly take up your contribution room the same way a group RSP does. Instead, it affects how much new room you get in the next calendar year in the form of a pension adjustment. By the way, deferred profit sharing plans do this as well. So if you're wondering why you don't have a pension, but also you don't have the maximum amount of RSP room available to you, it could be because your employer has a deferred profit sharing plan. But back to pensions. Typically, pensions will cover 70% or less of your highest earning year's income, meaning you will likely be in a lower tax bracket in retirement than in your earning years, especially considering the fact that you can income split your RSPs after age 65. That means that there is still room to utilize a key benefit of RSPs, moving income from a high tax bracket in earning years to a lower tax bracket in retirement. The additional consideration here would be old age security clawback. If you can project forward that regardless of how you structure your income, you will be in the OAS clawback range due to contributing to an RSP consistently on top of your pension. But alternatively, if you don't contribute to an RSP, you will not have OAS clawback, then a thorough cost-benefit analysis needs to be done on the contribution, because complete OAS clawback effectively increases your tax rate. Next, I'm going to be moving on to a question I get asked most frequently around RRSPs. What is the right income level to contribute? The answer to this question depends completely on a number of factors. Where are you in your career? Early career, mid-career, late career? What is your income ceiling? Should you be preserving RSP room for later years where you will be earning more? What does your retirement look like from a likely income perspective? It's impossible to assign an arbitrary income to answer this question, because for one person, earning $150,000 might be the most money they will ever make in a career, while for another, it's a stop along the way to earning $300,000 plus when their career potential is fully optimized. This is where professional advice is needed, and this is one of the things that we specialize in for mid-career professionals, so feel free to reach out if this is you and you have questions. Next, we are going to look at one of the most heated debates in the RRSP conversation. RRSPs versus TFSAs versus non-registered accounts. I was recently chatting with a client's accountant while we were reviewing a strategy to maximize their RRSPs. She looked at the projections and asked me a pretty fair question. She said, I'm concerned that the RRSP balance is going to get too big. So what's the plan to deplete this so we aren't creating a future tax nightmare? Now, this is a common fear. A big RRSP is considered a problem because in the year you die, the CRA treats the entire balance as income on your final return unless there's a spouse to roll it over to. So for example, if you have a $1.5 million RRSP in Ontario, that account turns into roughly $740,000 after tax. That's over a 50% decrease in value. So on the surface, people look at this and think, this is exactly why I should not use an RRSP. But as usual, what looks bad on the surface requires deeper analysis. Let's look at the math. For a high earner, in this example, someone making $300,000 a year in Ontario, your marginal tax rate is roughly 53.5%. So if you were to contribute $30,000 a year for 25 years, and we assume a 6% growth rate, you'll have a pre-tax balance of about $2.37 million. If you were to cash that out all at once at age 60, your after-tax balance is roughly $1.14 million. Now let's compare that to a non-registered account. You put in that same $30,000, your after-tax balance at age 60, after accounting for deferred capital gains, is about $1.98 million. At a glance, the non-registered account looks like it won by about $800,000, but this is not an apples to apples comparison. The piece that most people miss is that $30,000 RRSP contribution triggered a $16,000 tax refund. An honest comparison requires us to invest that $16,000 refund back into a non-registered account alongside the RRSP. Now the scenario changes. At age 60, you have your $1.14 million after-tax RRSP plus the value of the reinvested refund, which adds another $1.1 million in after-tax value. So the total value is now $2.24 million. Compare that to the $1.98 million in the standalone non-registered account. Even with the massive tax hit of cashing out the entire RRSP at once, the RRSP strategy still comes out ahead by $250,000. Now let's address the TFSA. If you could put $30,000 a year into a TFSA, which you can't, you'd have the full $2.37 million tax-free in our scenario where we cash it all out at once. In that scenario, the TFSA wins by about $100,000. But here's where the math gets interesting. Almost no one actually cashes out their retirement savings in one day. If we assume a normal retirement where you withdraw that money over 30 years, the RRSP actually beats the TFSA as long as your retirement withdrawals are in a lower tax bracket. The reason is because you got a 53.5% tax break on the way in for the RRSP. In retirement, if you're withdrawing $80,000 or $100,000 a year, your average tax rate will be closer to 25 or 30%. You are effectively making a 20% profit on every dollar just by moving it through time from a high tax year to a low tax year. Ultimately, high earners who care about math don't actually look at this as an either or problem. It starts with your TFSAs at low income years, then evolves into maximizing both. Then once that's complete, it evolves to non-registered investment accounts. Next, we are going to dive into a little known strategy that can actually cause you to increase your lifetime RRSP contribution room. If you're a qualified first-time home buyer, you can open a first home savings account. This account allows you to deduct your contributions of up to $8,000 per year. More and more people are choosing to rent versus buy in their life, even when they can afford to buy for various reasons. Even if you don't plan on buying, you should open an FHSA. If you are a high earner and you accumulate the maximum amount of RRSP contribution room every year, it's around $32,000, then your FHSA provides an additional $8,000 on top of that in tax-deductible contributions. So now between the RRSP and first home savings account, you can deduct $40,000 per year from your income. So let's say you do that for 5 years, which is the maximum amount of contributions you can make to a first home savings account. $8,000 times 5 years, which is $40,000. Now you let that $40,000 grow over the next 10 years. In total, you've had the account open for the maximum of 15 years, which is the maximum amount of time you can have an FHSA account open for. 15 years later, let's assume your $40,000 has grown to $80,000 through stock market growth. Your RRSPs have been maxed out every year as well. You now have two options: cash in your FHSA and pay income taxes on the withdrawal, or do a tax-deferred transfer to your RRSP. The FHSA has a special rule that allows rollovers to an RRSP to not take up RRSP contribution room. So in effect, you have now created $80,000 of additional RRSP contribution room. Next, we are going to look at a fundamental flaw in the way people view RRSPs and possibly why they get such a bad rep. When most people look at RRSPs, they look at the balance and think to themselves, I have X amount of money in my RRSP. Great. Now, when they go to withdraw and the government takes 30% of it, they get upset. Why? You're looking at this wrong. The government did not take your money. The balance in your RRSP is an illusion. You have to consider the fact that your RRSP balance consists of your money and the government's money. If you frame it like this, it gets easier to understand. I like to look at this as pre-tax and post-tax allocation. If you make $100,000 in a calendar year in earnings, no one in their right mind would create a budget to spend all $100,000. Why? Because we know we pay taxes on that money. So we make a budget to spend the after-tax amount. Remember in the beginning of my video how I said that RRSP contributions are just a way of deferring salary to a lower tax point in time? This is where understanding this can actually help you better frame your net worth. And this is especially important when you consider the popularity of things like FIRE movement and the FU money number. If that number is, let's say, $3 million, but two of those $3 million are in RRSPs, you don't actually have $3 million. It's also why the 4% rule falls apart here. Are you spending 4% of your pre-tax money or post-tax money? Are you calculating net worth pre-tax or post-tax? These are crucial distinctions to make. Okay, so now we've looked at strategies and hopefully we understand the value of accumulating your RRSPs, but what about withdrawing them in retirement? I'm going to walk you through the top 4 strategies studied and proven to optimally withdraw your RRSPs in retirement. Most people spend 30 years focusing on how to put money into their RRSPs, but they spend almost no time planning on how to take it out. If you just wing it and withdraw whatever you need to for your lifestyle, you are going to be the CRA's best friend, and you're essentially letting them dictate your tax bracket. Now, the goal is not to pay zero tax this year. The goal is to pay the lowest average tax over your lifetime. To do that, we have to look at 3 primary withdrawal strategies: smoothing, acceleration, deferral, and the last one is going to be RRIF meltdown. Each have a different purpose. First, let's talk about the smoothing strategy. This is all about targeting a specific taxable income threshold every single year. Instead of just draining one account, you're blending withdrawals from your RRSP, your TFSA, your non-registered accounts, and other pension income that you have. The reason why you would do this is because it prevents tax bracket creep. If you have a massive RRSP and you don't touch it, those mandatory RRIF withdrawals later in life will eventually force you into a high tax bracket. By filling up your current tax bracket now, even if you don't need the cash, you can move that money into a TFSA. You're essentially prepaying tax at a low rate today to avoid a spike tomorrow. Contrast that with the acceleration strategy, where here you're prioritizing redeeming your highest tax investments first. So your RSPs, RRIF, pension, income, all of those things. You leave the TFSA alone and you leave the non-registered assets alone. The logic is simple. Reduce the RSP balance as fast as possible in your 60s to lower the mandatory minimums that you'll be forced to take out after age 72. This is the best way to avoid the old age security clawback in your 80s. And more importantly, it avoids the tax wall at death. Like the idea if you die with a lot of money in your RSP, the CRA treats it as a single year's salary and half of it will vanish. Accelerating your withdrawals likely avoids the issue of having a huge RSP at death and losing 50% of your balance to taxes. And then there's the deferral strategy. This is the default. Spend your TFSA and cash first and let the RSP grow. While this strategy can maximize your pre-tax net worth or your paper net worth, it also can be a trap. It almost guarantees a massive tax bill for your estate and high mandatory withdrawals that will likely trigger OAS clawback we're trying to avoid. Again, this is where professional advice is needed to see if the after-tax estate is actually bigger doing this strategy versus one of the others. Now, once you actually convert the RSP to a RRIF, there are 3 tactical moves you need to be aware of. Number 1 is pension income splitting after age 65. After age 65, your RRIF income is eligible pension income. You can allocate up to 50% of it to your spouse. This is huge for shifting income from a high earning spouse to a lower earning one to keep everyone in a lower tax bracket. The second thing is that there's a $2,000 pension credit. If you don't have a workplace pension, convert just enough of your RSP to a RRIF to generate $2,000 a year. This triggers a federal tax credit that makes that first $2,000 essentially tax-free. Number 3, use the younger spouse's age. When you convert to a RRIF, you can choose to base your minimum withdrawals on your spouse's age. If they're younger, your required payment is lower. This keeps more money in the tax-sheltered environment if you don't need the immediate cash. Now, for those with a higher risk tolerance, there is also the RRIF meltdown strategy. This strategy uses leverage to deplete the registered account while creating tax deductions. You can take an investment loan to buy non-registered income-producing investments. You then use your RRIF withdrawals specifically to pay the interest on that loan. Because that interest is tax deductible, it offsets the taxable income from the RRIF withdrawal. The net result is that you've moved money from a taxable RRIF into a tax-efficient non-registered account without triggering a net tax liability in the current year. It's complex, but for the right portfolio, it can be effective. But a big warning on this, I've seen countless RRIF meltdown strategies implemented, but very few actually work as planned. It requires constant monitoring. It requires control of your cash flow. It requires a strict time frame. It requires amazing emotional and high risk tolerance, which a lot of us at 70 probably are not going to have. This is not advisable in 99% of cases. I look at this as added complexity with low probability of effectiveness. Doing the math on these scenarios based on your current situation is crucial to know which one's actually right for you. Okay, so now we've looked at accumulation and decumulation strategies. I want to touch on an overlooked but really important part of RRSPs, the beneficiary designations. When you die with an RRSP and you are married, you can roll it over tax deferred to your spouse. But what if you don't have a spouse or your spouse has predeceased you? Then you have some options. Most people will name their adult children as beneficiaries on their RRSPs due to the fact that naming a beneficiary will bypass something called probate. Essentially, it just lowers the cost of estate distribution. The problem with that is that there are still taxes owed on the RRSP, and those taxes are owed by the estate. When you name a beneficiary on an RRSP, the entire pre-tax amount of that RRSP goes to the beneficiary, but the taxes are owed to the estate. So how does the estate pay those taxes? Now, if there's not enough liquid assets or cash in the estate to cover the tax bill, this presents a big problem because the government will call to collect. The situation gets even more complicated when there are multiple beneficiaries of an RRSP. So say you have 3 kids and you assign each of them 33% of your RRSP balance. You pass away and the money is distributed pre-tax to the beneficiaries. 2 of the 3 kids are responsible and don't spend the money. The third blows it within the first month of receiving it. A year later, when the tax bill is due for the estate, there isn't enough money to pay the tax liability of the RRSP cashing in. So the CRA calls the beneficiaries saying, hey, pay up. However, one of the 3 kids has already spent all their money. So now the other 2 kids are on the hook for the third one's tax bill. So talk about a recipe for family issues. This is why most professionals recommend leaving the RRSP to the estate instead of directly to beneficiaries, especially when there may not be enough funds in the estate to pay the tax bill. This is where the will comes in to distribute after-tax estate values in accordance with the wishes of the person who's passed away. Now, this results in a situation where instead of reacting to chaos when there's not enough money to pay the tax bill, the extra cost of having your RRSP assets going through probate is pretty small compared to the peace of mind it will give the family. Now, this is not legal advice, so always get competent tax and legal advice around beneficiary designations. RRSPs can be a great tool, but I would be wrong to not talk about a risk of contributing to it based on the logic I've presented in this video. Mainly, I assume no major increases on middle-class tax brackets. We all know that governments can come in and change things in the future. Future tax risk is impossible to account for. If the government comes in and substantially increases taxes in the future, many of these strategies can become not as useful. That is always a possibility. However, I encourage you not to make decisions based on things that are possible but not likely. If we did, we would not invest money, we would not plan anything because there is no certainty baked in. There are always some people, even some professionals, that take this uncertainty to the extreme and claim RRSPs are a scam. Now, most of these people tend to have ulterior motives. Mainly, it's an insurance bro's best argument is to claim that RRSP, we don't know what the tax brackets are going to be in retirement, so therefore they're bad products. So buy my insanely expensive high commission life insurance policy instead. Look, tax rates would have to increase substantially on income levels for middle-class Canadians for RRSPs to no longer be useful.